Hello and welcome everyone. I'm Gareth Brown from the Forager International Shares Fund, and I'm joined by my colleague Alex Shevelev from our Australian fund. Hi Alex.
Hi Gareth, hello everyone.
Today we're going to talk about the prospects for the world getting back to normal after COVID-19. We're going to talk about the risks and opportunities from an investment perspective and how we're positioning both funds around this topic. The focus here is on stocks that have been hit hardest by COVID and that probably stand to benefit the most from a return to normalcy. We're talking travel-related names, airlines, airports, car hire companies, travel sellers, and also some of those other businesses that rely on the movement of people, automakers, car dealers, etc. First, some background, and this is a very broad generalization, but certainly from an international perspective, we came into March last year, the enormity of COVID-19 all dawned on us pretty quickly, and most of these exposed stocks fell something in the magnitude of about 50%. Over the following month or two, so I'm talking April, May 2020, most of them regained about half of their losses. And then there's been chop and change since, pretty much a few fits and starts around the vaccine, but we haven't recovered the full valuation for most of these businesses. As I said, that's been our experience internationally. When we talk about this reopening trade, what we're talking about is the opportunity to capture that, let's say 20 or 40% upside if, and I repeat, if the world returns to how it looked a couple of years ago. Alex, has that been your experience here in Australia?
Well, 20 to 40% would be nice, Gareth. I think in Australia here, we've seen a lot of those stocks. We're talking the flight centers, Webjets, the corporate travel, Qantas, Sydney Airport, stocks like that are largely at their pre-COVID market caps. Keeping in mind, of course, that some of these businesses raised capital to keep themselves afloat during that COVID period. Now, in late November, they were actually even higher than they are now. So enthusiasm has faded somewhat. Back at the end of November, it was closer to 15% above the pre-COVID market cap. So investors were getting very excited with the announcement of the vaccine news that all of this was going to be over very quickly. But there is a reality here. And so things will, as we're going to talk about shortly, get back to normal, we believe. But it's not going to be this year. It's probably not going to be next year. And we're really talking about financial year 23 for the normality that we're going to be talking about to return. And of course, complications around this. So these companies will have various exposures to leisure travel, to corporate travel, to domestic, to international, the stock-specific issues around does the company have the capability to continue to operate and get to that FY23 promised resumption of normality. I've been talking there about the travel names. There are, of course, the other reopening trades, and we have some of those in the portfolio we'll talk about later on. But in broad terms, the casino names, for example, are 10% below where they were in pre-COVID times, but some segments have roared ahead. So AP Eagers, the largest automotive dealer in Australia, is 50% above its pre-COVID market cap. So lots of variability there.
Yeah,
now let's talk about.
We've seen that in the UK as well, with really strong used car prices that have been buoying the profitability of the dealerships.
That's right. So let's talk about the reopening, and let's talk about the confidence that we have in that reopening. So I'll hand it over to you.
Yeah, I'm probably a bit more bullish than you. I think it's not a 23 story anymore. Firstly, I think the path to normalcy was there even without a vaccine, and maybe it was a 23 story. But we have multiple vaccines now that they're effective. They're relatively effective in stopping people from catching and spreading COVID-19. I think more importantly, they're effective in stopping people getting severely ill from it and dying from it. And I think we're starting to see the data from the countries that have the high vaccination rates, it's a cause for optimism. So chart one that you can see there shows some of the early leaders in vaccinating. UK is now 15% of the population done and dusted on their 2 vaccine shots. Most of the high-risk populace, most of the potential super spreaders like healthcare workers have been vaccinated. US is 10% of the population. Israel is nearly 60% of the population. The next slide you see there shows, I think, a tipping in the balance in terms of the daily new cases. Unfortunately, I couldn't get per capita data there, but it shows all three of those countries, new cases down about 40 to 60% over the last few weeks since the vaccine's been ramped up. Chart 3, which we're bringing up now, shows hospitalizations appear to be turning down too. Obviously, hospitalizations lags new case data, and also this data I've got here is about a week old. So things have improved further since, some early good indications. I don't want to be accused of cherry picking here. We're also seeing really good improvements in some of the countries that have a low vaccination rates. Ireland and Germany come to mind in particular. The news from Italy is a bit more mixed. Spain also seems to be getting worse, if anything. It's hard to untangle what's related to vaccine and what's related to, for example, new lockdown measures. But I thought it was a really interesting article in The Economist on the 3rd of February. It broke up the Israeli population by age cohorts. So there was an over 65 group, and then there was a group that was, 40 to 60, something like that. And what it showed was the improvements in new cases, in hospitalizations, and severe hospitalizations the improvement's been much sharper in that over 65 category, which are the people that obviously got the vaccine earliest and most of them have had it. So I think that was really interesting information. The last potential fly in the ointment was the mutations that we've seen come out of UK, South Africa, Brazil. It was possible that these would be more resilient against the vaccination efforts. We've seen some really interesting numbers starting to come out there from several of the vaccine providers. The one I came across most recently was the Johnson & Johnson vaccine. Its efficacy is lower than some of the other vaccines, but it seems to reduce hospitalization significantly and deaths close enough to zero, including on the mutations, or at least some of the mutations. So some good indications there. Alex, do you have anything further on that matter? I guess maybe we can run through how the Aussie fund's positioned in terms of both risks and opportunities.
Gareth, the fund at the moment is positioned in these two categories we've spoken about. So the direct tourism exposure is about 7% of a portfolio. And in that, we've got predominantly two stocks. Experience Co is a provider of skydiving and reef trips. Now, as you can imagine, international tourists really helped to increase the numbers in both of those categories. But especially through summer, the domestic market is something that can be quite profitable for Experience Co. The other is THL, and it is a rental company and a seller of camper vans. Now, it's been a bit of an interesting dynamic in camper vans in the last little while because it's been quite a good socially distant holiday that people can take while they're unable to do many other things. Yeah. So in this case, again, international tourist recovery will be helpful for the business. But in the meantime, they've reduced the leverage in the business by selling some of the used camper vans that they no longer have need for, given the volumes have reduced. On the broader reopening exposures, here we're talking about 10% of the portfolio. For us, that includes the casinos, Sky City and Star Group. Those are mostly domestic businesses, but again, the movement of people into and out of those venues is very important. And another couple of interesting stocks that we put into the reopening trade. One is AMA, a panel beating business. Now, AMA is benefits strongly when people start driving around and when they start having bingos, as they no doubt will do. A lot of the activities returned to normal there. With some company-specific issues, it's taken time to follow through to the share price of AMA. Another is Life 360. Life 360 has got an app to track your teenage and older children, predominantly in the US. So as those children start leaving the house and driving, parents often like to keep an eye on their location. That's been much reduced in the US as the movement of people has declined. So growth rates for Life 360 have slowed. And as people start moving in the US, that should pick up again. So let's switch over to the international fund now, Gareth. Are we seeing similar trends there in terms of exposure?
It's probably roughly the same amount, maybe even a little more, depending on how you cut the pie. Look, we owned plenty of this stuff prior to the March downturn, so we fully experienced a lot of the pain, but we added towards the bottom and we've added selectively since. I wouldn't say we've pivoted particularly aggressively recently towards reopen. There remain risks, but we've held on tight to most of what we own where we thought the valuations were justified. In travel, we own Vienna Airport, an obvious beneficiary of a return to normal. We own SkyWest, which is the sort of last leg provider of flights in the US's hub and spoke system. We recently took our profits from European low-cost carrier Wizz just because the valuation had reached full potential or fullish potential. We have a smaller holding in Dolphin Capital Partners that owns Greenfield Resorts in Greece that is liquidating. We also own some tourism holdings. It's the one position we own in both funds. More broadly, we own an auto parts company in Canada, a UK car dealership, a recreational boat maker in the US. We own a couple of bricks and mortar retailers. Some of them we've taken a bit of profit off more recently. Maybe even Uber belongs in the reflation, the reopening bucket, I should say. Part of its business is a direct beneficiary on the ride side. The food delivery business will probably face a bit of a headwind when life gets back to normal. Broadly well positioned, and we're not betting the farm on it.
That's right. Thanks, Gareth. So as you can see, as Gareth's mentioned, the exposures are there. They're not betting the farm. And we do stand to benefit across both funds if activity, movement of people, reopening happens quicker than other investors at the moment believe it will. Now, the other interesting thing there, and you heard it from both funds, is that the stocks we're largely positioned in have lower balance sheet risk, that is lower net debt levels. And that gives us the ability to move through and survive through to the reopening, whether that's FY22, FY23. So thank you everyone for tuning in. We look forward to speaking with you again next time.